Yes. Hi, everyone. This is Finance Meets Real Estate. So we're in the last week of the year. It's our 52nd webinar this year, live webinar. So as you guys know, we do live webinars every Tuesday. We are a meetup and webinar out of New York City. We have Blake Dailey here today. He's a great guy. He's going to talk about Airbnb. He's sort of doing the BRRR our strategy, like buy, rehab, rent, refinance, repeat, with the added kind of like with the added benefit of Airbnb. So he calls it like BrrrRBNB, right, or something like that.
BrrrrBNB, come on now.
BrrrrBNB, yeah. It's a lot of consonants there. So that's you know, like he's also an active Air Force duty, like an active duty Air Force officer, I guess. And you know, he has a great background in syndication and private real estate investors, etc. So with that, I'm going to pass it on to Blake if you want to introduce yourself. And if you guys have any questions, feel free to put them on the chat, and we will relate at the end. Or you know, if you feel like you want to speak up, that would be great as well. So yeah, with that, Blake, it's your on.
Yeah, thanks, Stefan. Appreciate the introduction. So as he was saying, active duty in the Air Force right now, stationed in Panama City in Florida, and been investing in real estate since I've been down here. Got over 100 units now. Really fell into this Airbnb strategy, and it was never really the intention. It was more of a necessity how we got started with Airbnb. We started with the house hack, and wound up actually making money living for free. So that was pretty cool. And from there, did some BRRRRs after the Hurricane Michael down here, fixed up a lot of hurricane damaged homes. I'm a contracting officer in the Air Force as well. So those two skill sets carry over really well. And got into multifamily, then bigger commercial multifamily, and came back to, I guess, my roots with Airbnb investing recently, and purchased some boutique hotels that we've stabilized 2 of them, and we're working on stabilizing our last 2 in the coming 3 months, about Q1 of this coming year. So been busy, but been fun the last couple months.
Awesome. That sounds great. So since when did you get into like the kind of hotels and Airbnb? Because I believe if you want to like share your background, like initially like how I started with investing, and then perhaps switching to syndication, and then getting into this like more like kind of syndication with short-term rental aspects.
Yeah, so that's what I'm going to talk about tonight, is that pivot from really, which was kind of my staple, was multifamily. That was a big focus for me. Closed the syndication earlier this year, and then pivoted back away from that just because of what I was seeing in the market, and the opportunities that seemed like they were drying up, got really competitive. Prices were going up, returns were going down, and got more into the Airbnb, which I've had and been growing kind of in the background this whole time, but kind of handed them off to a property manager so I could focus on syndication, and came back to it in a big way, I guess. But going back to the beginning, I from that point, when I got to this duty station, my wife and I, recently married, were staying in temporary lodging on the military base. And, we had some time to kill before, before closing our first house. So thought it'd be a good time to sit and write handwritten letters. So doing direct mail, driving for dollars, writing down the addresses, looking them up on the county property appraiser's website, and then putting these things in the mail, a batch of 50 or 100 at a time, writing them until my hand was cramping. And my wife would write all the return addresses on and put the stamps on the envelopes to help me out. So we got started in direct mail, started doing that and doing some wholesaling, got some off-market deals, and was, learned the negotiating with sellers, the marketing side of the business, the renovations and the underwriting for these BRRRRs that I was getting into or preparing for, I guess, by just, practicing on hundreds of properties that we were reviewing and driving by.
Sorry, if I may interject like really quickly, I just want to ask. So actually because you mentioned direct mail, that you guys started out with that. So how did that work for you, just to the benefit of our audience? Since I know like it seems the bigger share of like kind of commercial deals discovery seems to be in on the agent side, like kind of like having agent relationships, and then some portion with direct mail. So how did it go as far as like your personal experience and, success that you had with that, and maybe some disappointment sometimes, etc.?
Yeah, that's a good question. I think, to kind of start at the end and go backwards, I think those, at least in my circle that I've talked to, have been having the most success dealing directly with sellers, especially in the last year. Competition has been really stiff. So people going off market, they've been able to source a lot of opportunities that, with brokers, with brokers and agents, it's tough because it's all, I don't know. I mean, I'm sure the people in this group and yourself as well have dealt with those agents, and it's a different dynamic than when you can talk directly with the seller, find out, the reason they're selling, and get down to the issue and solve their problem. Because behind every sale, there's motivation. If you, in wholesaling and doing the direct mail, you figure out how to hone in on that motivation and not take advantage, but use it to your advantage in getting a good deal. So, whether you're mailing out of state landlords or you're mailing an eviction list, you're targeting different sources of motivation. And then you're, dealing directly with the person who's experiencing the stress that's going to force them to sell at a discount. So all the skills wrapped up in that at the early stages were really big for me and my development to get me where I am now. And even our recent deals, 2 out of our 4 commercial deals that we've done this year, 3 out of 5 have been direct to seller. So we've dealt only with the seller, no agent involved. And they were like some of the toughest deals I've ever done because the stakes were higher. There was more zeros on the end, all these kind of things. And just the asset class we were targeting made it really tough as well, which we can get into in the presentation. But if I was dealing with an agent, those deals I don't think would have came to me in the first place, or ended up working out by dealing through that third party and going through the intermediary. But I got to deal directly with the sellers and figure out a way to make it work.
And are those like primary, like secondary, tertiary markets? Like, I assume it works a little better in like secondary, tertiary markets as far as direct mail.
I mean, it can. The people I know that have the most success with them are in primary markets, but my markets that for me specifically are in secondary markets. Maybe even one being called a tertiary market, but they're secondary markets. But I mean, it happened. I know people that do it in towns of 5,000 people. I know people that do it in some of the biggest metropolitan areas in the U.S. So direct mail and working directly with sellers literally is ubiquitous. It works everywhere.
Yeah, that's great. And so works everywhere across deal size as well, right? I mean, so because we have a question on the chat. So what size of deals were those, like the 3 direct?
Yeah, it's the same. It's literally any deal size. I know guys who are sourcing direct to seller deals on, apartment complexes. And I know guys who are doing it on mobile home, like single mobile homes and residential properties. I definitely, the bulk of it is in the residential space, single family rentals and, fix and flips and wholesales, that side of things. But there's absolutely a market for it in the commercial space. And that's what you refer to is in the commercial space, excuse me, most of the deals trade with brokers. I think I remember seeing the statistic as I was, looking at all this stuff in the past, but I think it's like 90% plus of commercial multifamily trade with brokers. So you're dealing with a very, small percent of transactions, but what do the brokers do? They call property owners and spend time fostering relationships, using their brand and their marketing. And if you can do that as an individual, you're going to have the direct access to the seller, and you're not going to have to deal with the broker in the meantime. Now, that being said, I love good brokers. I've had good brokers bring me good deals and good agents bring me good deals. And I have a few agents and brokers in my local market that, are my first phone call. If I have, questions, or if I'm going to sell one of my properties, that's who I'm calling, because they know everybody. They know the market. They know how to market your properties, all that kind of stuff. So a good broker is invaluable. But on the buyer side, I think it's prudent to, work with brokers and have your own source of, whether it be networking or direct mail or whatever way that you can get leads, because ultimately as a buyer, you want to treat it like a funnel. So you want to pour in as many leads as possible into the top of your funnel, screen them, underwrite them, and analyze them, and ultimately offer on the ones that work for you. And then you get down at the very bottom are the deals you close on. So the more deals you can put in the top of that funnel, the more deals you're going to close. So, find your good brokers. If you're starting out in the single family space, do the direct mail, do the cold calling, call for rent ads when you see the sign in the property in the front yard. All those different things are potential leads and repetitions for you to learn and build your skills.
Yes, yeah, that makes sense. And I guess you're touching on, okay, it's kind of a more data approach when you do direct mail than with agents, right? You can build your funnel, you can kind of
marketing is definitely
marketing
for properties is definitely data driven and KPI
yeah.
analyzing what's working and what's not.
Mm-hmm. Sounds good. So if you want to go more, Blake, into like what you guys are doing now and kind of the
absolutely. If I can share my screen, I can
absolutely go ahead.
Bring up some slides and talk to you guys about excuse me, I'm still getting over a cold, so if I cough a few times, it's just me itching the back of my throat.
No worries.
But what I'm going to talk about is the pivot that I personally made and the perks of doing so, pivoting away from commercial multifamily into the BrrrrBNB strategy. So, 11, 12 months ago at the beginning of the year, if you asked me what I was focused on, what I was doing, where my time was being spent, it was absolutely on commercial multifamily, on sourcing deals, on, broker relations, on investor relations, meeting new private investors to invest in syndications, finding deals, all that kind of thing that comes into multifamily syndication when you think about buying multifamily properties. And in February of this year, 2021, I closed with my partners. There's a lot of, definitely the strength of the team, not all me there, but we closed a 66 unit apartment complex in Greensboro, North Carolina. Awesome market, awesome property. I got a picture of it here. Really good looking property. And it was one of the few good deals I had seen that year, and I jumped on it, and it looked really good at the time. It's operating really good now. Rents are surpassing what we expected them in our pro forma. So that's all great. But there just wasn't many opportunities that we were seeing like that. And we were spending, or me personally was spending, dozens of hours a week diving down this rabbit hole of commercial multifamily and really not getting the return on my time or, getting the deals that I wanted to, or that maybe I expected to, with everything else that I had seen. So I began to look at complementary asset classes that could have the same benefits as commercial multifamily. And that brought me back to, what I had known, and I'll talk about this more, but where I had experience, what I was good at, and that was short-term rentals. I had 7 personal listings, personal Airbnb listings at the time that were, cash flowing great. They were BRRRR properties, they were BrrrBNBs, and they were awesome. I was able to BRRRR them, get all my money out so that I had no money left in the deal, pay back private investors. I was clean. And then they were cash flowing like crazy. So it was something that I knew worked. And that's something I was looking at, doing at the scale of bigger properties that I knew would work as well, or I guess felt very confidently it would. So that was my pivot. And that's what I'm going to talk to you guys about today. So a little bit about me. I kind of gave my, background, but wanted to give this because sometimes I know I've been sitting in the webinar seats. Like, why are we even listening to this guy? So current portfolio is 129 units, 63 of which are these BrrrBNBs, which we're going to talk about. The other 66 is that apartment complex, which had tons of help. I have a very small piece of the apartment complex, but still, it was cool to do. Of the 63, 4 of those are boutique hotels, which has become a really cool asset class that I've begun to like a lot. That scales up the BrrrBNB strategy a lot. Have done 10 plus BRRRR projects, 5 of which of commercial, really large renovations that we've done over $1 million of CapEx this year. So managing a lot of money moving around and using this BrrrrBNB strategy that we're going to talk about was able to surpass my W-2 income in 1 year with this strategy. So I don't know what everybody's goals are, but I know that a lot of people get into real estate investing to get, to replace their income from their W-2 so they can have the financial freedom to pursue other passions. I'm in the military, so it didn't work out exactly like that. So it was surpass, not replace, because I couldn't necessarily go to my boss and say, hey, I'm moving on. But for you guys, this could be really applicable for you. So starting out in multifamily, at the beginning and working the way to the pivot, the pros of multifamily are very apparent, and I still think they're very true. It's passive. You can, if you get above a certain size of commercial multifamily, it becomes very easy to manage. You're an asset manager, not a property manager. So you're not dealing with tenants and toilets, and it can really be more hands-off management of the asset. It's very scalable. Once you get the systems in place, you can manage a much larger portfolio as you grow. It's efficient. So you've got the economies of scale. It's actually, cheaper to run or cheaper and easier to run a 100-unit apartment complex than it would be like 100 different single family houses. And I've kind of figured that out from experience having houses all over the place. You got, different repair items, different, properties with different issues that, when you have all under one roof with the same systems, it becomes much easier. And it's simple. It's definitely not easy, but it is simple and straightforward. And if you, follow a certain, process and steps, it becomes easy to manage. But the cons of that and what took me away from multifamily earlier this year is that it had compressing cap rates. So, people were willing to pay more to get, the same return, or really that lowers the return. It became a very saturated market. There's lots of competition that pushed the returns down. And what happened really after the pandemic, but specifically in 2021, is there's been competition from big money. So Wall Street and hedge funds, insurance companies are buying.
Blake, just for our audience, which markets were you looking at the time in terms of, like, let's say, the market saturation?
Specifically throughout the Southeast, the Carolinas, Florida, where I'm at, Texas, Georgia, mostly the Southeast. So yeah, continuing on there, competition from the big money, so that you have these big money firms that have investor money to place, and they're going to put it in something that's easy for them to manage because all those pros above. So of course they're going to pick out commercial multifamily as an asset. And it just became to the point that I noticed that I couldn't compete. And, a lot of other people I see couldn't compete against those big money offers. People are paying way too much, in my opinion, way too much for these properties, and pushing the cap rates down. So it became a less appealing asset class as it kind of unfolded after all the money that was tied up during the pandemic came out to play, and it all seemed like it was going towards commercial multifamily. But I definitely still am a believer in multifamily as a long-term wealth builder, just not really a believer in overpaying or waiting too long to achieve that wealth. And if you can still get a good return in a safe asset class, but if you're going to overpay, it's going to take a lot longer to realize that return. And that's not something I was willing to do. I didn't feel comfortable raising money for those kind of deals. So I just got away from it, but something we'll probably get back into in the future. So when needed, pivot to, and this comes from, I believe it's Good to Great. And it's these three things that you really have to do well. And think of it like three intersecting circles and your niche or your business in the middle. And it's got to be something that you're good at, specifically something that you're, the best at or better than your competition at, because you've got to be able to outcompete and outperform others that are doing the same thing. It's got to be something that you're really passionate about, because if not, it's going to feel too heavy. You're not going to want to put in the work when the going gets tough. So the passion helps you get through that. And then the third thing, there's got to be that economic driver. Right. So you got to be able to make money. So if you can find what you're good at, what you're passionate about, and where you can make money, that's an asset class. That's an area, that's a business that you can do well on. And when I was thinking about where to go outside of multifamily, these are the things that I thought about. Where's my experience? What am I good at? What do I really like doing? And where can I make more money than multifamily? So that's what led me to pivot to the BrrrrBNB, which we're getting into now. So that was due to the oversaturation, which we talked about. Excuse me. But I still wanted that power of commercial real estate, the passivity, the economies of scale, all the things that we talked about. And I wanted to be able to combine that BRRRR strategy. And it led me to short-term rentals with my experience there. And what I found was I could get the equity building power and the high cash flow at the same time. So really it was the best of both worlds. So it was marrying those two things there, the BRRRR strategy with short-term rentals, got BrrrrBNB. So I guess what is BrrrrBNB? Kind of alluded to it, but it's the combination of the BRRRR strategy and short-term rentals. That's the B&B, or bed and breakfast. And for those of you that don't know, the BRRRR strategy is an acronym. It's for buy, rehab, rent, refinance, and repeat. So it's a framework to kind of systematize what's going on there. You're buying undervalued properties. You're renovating them to bring them up to market value. You rent them. And this is obviously where the difference comes in. So you're going to rent it as a short-term rental and then refinance, get your money out and take that same money, do it all again. And why I chose this strategy and why I like it and why I'm trying to, convince you guys of it and teach you something new here is because the increased cash flow, it's got the velocity of money, or, your equity gain, your build up, your net worth growth, all that stuff. And then it allows you to reach your goals faster, basically because 1 and 2. So getting in these a little bit more is the increased cash flow. That's, number one reason why a lot of people like this short-term rentals is because you can get the higher cash flow. So from what I've personally seen in my own portfolio and, talked with dozens of other short-term rental investors who have made the pivot or have both long-term and short-term rentals, is that the income is about 3 to 5 times that of long-term rentals. So your cash flow is going to end up being 3 to 5 times more with short-term than it will with long-term rentals. And each one of my properties, cash flow is around $1,000 a month net after all expenses. So that's one reason I loved it. And I saw, in my own P&Ls, what was happening there. I was like, wow, this is, pretty cool. Cause I had the short-term rentals and the long-term rentals and could see, the sway, the disproportionate amount of my, income, where it was coming from. Number 2 is the velocity of money. So on top of making more money each month, you can also repeatedly use that same, chunk of capital to go out and do more deals. Then you replace it, then you do it, use it again, replace it, use it again. So that allows your money to compound and grow faster. And all the while your cash flow is going up, that pool of money is increasing while it's still out working, making those big equity gains and coming back. So this is like where you're going to get the most bang for your buck, is compounding and doing more deals with the same stack of money. And then because of 1 and 2, which I was talking about, is by increasing your cash flow and speeding up, increasing your velocity of money, you can reach your goals faster. I mean, think about it. How many properties would it take cash flowing $1,000 a month? How many of those would you need to reach your goals? I imagine a handful, maybe. That's what it took for me. I think at the time when I, reached my W-2 income, it was, I think, 3 short-term rental properties and a long-term and 2 long-term rentals. Like, it was not that many properties. It was 5, easy to manage. And it was what I needed at the time. So it doesn't take that much. So how this whole process works is, digging into this BRRRR process of it is, first you got to buy, right? You got to find a below market deal. You can't go, excuse me, this cold's kicking my butt. You can't go on Zillow and ask the agent, hey, how much money can we pay for this deal? You got to be able to find good deals. You got to be able to find value that others are missing. And, we talked about that earlier. You can, have good agents working for you. You can be writing letters, making calls, all those kind of things. But it's imperative that you have to have a good deal, because you need that built-in equity to be able to BRRRR. So, and then on the buy side, got a couple options. You can use a hard money lender, private money lenders. You can use your own cash. You can use a line of credit. If you've got other properties with equity in them, you can use partnerships, all those different ways. There's so many different creative finance strategies. I've used a ton of them personally myself because I started out with no money. So I had to use creative finance, but there's ways you can buy these under market deals. But the first key is you have to find a good deal. Next is you're going to do your rehab. And it's really important here that you have to know your market and bring it up to the standard of that market, right? You can't, be in a luxury neighborhood and, do a C-class renovation and get the most bang for your buck. And likewise, you can't buy a property in the ghetto and deck it out like a mansion and get the most bang for your buck. So you really got to know your market, got to have a good contractor, find a good contractor. And that's a whole presentation in and of itself. A lot of trials and tribulations myself this year with contractors. But this is where you are taking that undervalued property and, bringing it up to market value and capturing that equity in between. So very, very important. And once that's done, that's when you go on to the rent strategy, which highlighted blue here, because the difference is that you're going to do it with short-term rentals is, get the listing live on Airbnb. That's where, probably 70% of people book. So I always suggest starting with Airbnb because that's where you're going to get the most eyes on your listings. That's going to equal, the highest income for you. Then just put the systems in place to manage that, which I'm going to get into. Managing the property, managing the guests, making sure you're actually capturing and realizing that higher cash flow. Then when you go to refinance it, you're going to want to find a lender who will lend on short-term rentals, which, it's going to honestly probably take a lot of phone calls. It's different in every area. There's more of them popping up, but if you're not willing to put in the time, this whole BrrrrBNB strategy is not going to work out well for you because it's going to take, I've been through it. I know it's going to take some time to find the right lender, but if you use commercial loans with a local community bank, I think that's going to be your best option. That's what I've used for most of mine. And that all really comes down to the relationship, showing that the cash flow will more than cover the mortgage. The banks are going to look at the DSCR, the debt service coverage ratio, to make sure the income is going to cover the debt on the property. So Freddie, Fannie debt may not work here. So build those relationships with local lenders. And then finally, where the magic happens is being able to repeat that whole process, finding a good property, having a good project work out. You get that listing live, income coming in, refinance it, get the money back, and then put it into the next deal and keep growing your portfolio and to reach your goals.
So Blake, if you may, sorry to
yes,
if you may
jump
go
in.
into the part with the local community lenders for the debt service coverage ratio and kind of what revenue are they going to actually count towards it? If you want to go a little bit into that, since I know, let's say, for example, in conventional financing, the residential side, you may have, 75% of their projected rent roll. In the event it's a projected rent roll, is counted as, let's say, some kind of income of the potential multifamily.
Yeah, so that's where it does get a little bit tricky, and that's where it comes down to the relationship. I've seen it work out different ways with different people, with different lenders. But if you can, make a really nice presentation to them and convince them that this is what this property is going to bring in, you can use data from either Airbnb itself by opening up a spreadsheet and aggregating it yourself by looking at local listings that match your amenities, match your heads and beds, your location, all that kind of thing. And then, taking the rates down in a spreadsheet, and then you can see their calendars. So you can, see roughly what their occupancy is, and then projecting out their monthly income. Or you can use a service like AirDNA, which is what we use to pull all of our data, which goes through on the back end of Airbnb and VRBO and scrubs all their listing data and gives us, occupancy rates, average nightly rates, all this comprehensive data to be able to use to underwrite our properties, to make projections and pro formas, and then also, ultimately present to lenders. Mash Advisor is another one, I believe, but AirDNA is what we use. Is a really good service. I like it a lot. So those are a couple ways.
Would they kind of discount? Would they discount the short-term revenue relative to kind of a long-term revenue?
I've not seen them discount it. I've always presented mine very conservatively. to get to, what would be my net income. And that's obviously what they're going to use to quantify the debt service coverage ratio. And every bank's going to have a little bit different DSCR. But the local community bank that I use, if it meets a 1.15, they'll lend on it. I've got the relationship with me. They know my strategy. They've, hold several of my loans that they know are short-term rentals. But I've written, like, to get to that position in the first place, I'll just share quickly what I did to make them comfortable with it. Was doing all that stuff about what I just said about showing the data. And I just, kind of gave them the raw data and, analyzed it to say, here's the average of that. And if I'm conservative and I say I do, only 80% as good as the market, to add that conservative factor to it, here's this number. And then I put that number in as my income. And then I pad my expenses to say, what, if I run this a little bit fatter, here's what I get on my income. And then it still met their DSCR. And then also wrote just a one pager about, the strategy, what I was going to do to manage it. I shared another page of, what I had done on the wholesaling side, and at the time I had one Airbnb in my house, and showed all the data from that, from basically year to date at the time. And then showed them all my holdings and my properties, and, basically my P&L for my whole portfolio. And that was, the kind of the sum of the parts that they needed to say, okay, one, this guy knows what he's doing. Two, he presented it in a way that looks good and makes sense to us. The numbers work. I mean, here's what it should do based on the market data. And he's, underwriting it here. So that, gave them that conservative factor. And I don't know, maybe they just took a risk on me and it worked out. But since then, it hasn't really been an issue. Cool. Yeah. Any other questions on the refinance or the lending? This is I think I have another slide in here, but this is a super important aspect of it, because if you get through the BRR and then get stuck at the third R, you can definitely have some issues. But there are more lenders out there. They're popping up all the time, especially as, we've kind of stabilized post-COVID. Everybody's looking for a return. There's more kind of portfolio and hard money type lenders who will lend at, decent 7 to 9% rates, which is super high if you're looking at it compared to like a Fannie Freddie conventional loan. But if your property can support a 7% loan, then, those are definitely out there in abundance right now.
Right. So a question from Michael on the chat with regards to the refi, since you mentioned, so what percentage of your initial acquisition costs are coming back through the refi to use on the next deal? Well, I guess it's more of a burden.
So what percentage of like the initial like all-in costs are coming back of the refi?
Yeah, I guess that's the BRRR.
Yeah. So my portfolio lender will do portfolio, meaning that they, basically lend the bank's money. It's not, sold to Fannie or Freddie or packaged and sold. It's like they hold it in-house portfolio loan. So commercial loan, they'll lend 80% LTV, and several of them around here will do that anywhere from 75 to 80, but mine will do 80. And on the projects that I've done so far for the BrrrrBNBs we're talking about specifically, have been completely paid off at the refinance. So no money was left in them. All the initial money was paid back, whether it was to a hard money lender or a private money lender, whatever the initial funding source was. And then, it's got a fresh new, 25-year amortized loan, and at, I think, anywhere from probably 3.75 to 5%, depending on when it was closed.
That's great.
Yeah. Any other questions on the refinance or the lending before we move on?
No, I think we're fine. We have a couple of questions, but we will relate at the end on other topics.
Okay, cool. All right. So wanted to add this in here, kind of getting back on track, is why the hospitality instead of multifamily, especially right now? You know, why make the pivot in the first place? Why not just stick it out, increase marketing, or underwrite more deals or whatever? And the reason was because I was seeing what was happening at the time of the pandemic. You know, travel was shut down, hotels were hurting, the hospitality industry, took a shot in the shorts pretty bad. So what that led to was less competition because of COVID. Cap rates were rising because people were, basically it's a risk adjusted return. So it was seen as more risky. Cap rates were going up. There's also more inventory. So there was not only going into forbearance and foreclosure with people that, hotel operators that couldn't, service their debt because they had no guests. So there's more inventory because of that. But just because like the sale volume went down, like hospitality was just not an industry, money wanted to flow towards. So I saw that as an opportunity. It's like the whole Warren Buffett thing. When people are being greedy, you should be fearful. And when people are fearful, you should be greedy. And much of all of 2020 and much of 2021, maybe pivoting in the last couple, 6 months or so, has been very fearful on the hospitality. And also this last point is, there's really high equity gain. So with the proper turnaround of these properties, you can massively increase the NOI, which is going to directly affect the value. So, some of the properties we bought were doubling or even tripling the NOI on these properties, which is, shooting the value through the roof of where we originally paid for them. So it all comes down to lower prices, less competition, and higher returns. So I think that's something everybody wants. And I just, saw the path towards that and jumped on it.
So bigger.
And that's actually one of our properties that we bought earlier this year. So that's the Moose and Maple Lodge and Lake Tahoe.
So Blake, just for our audience, right? So let's say high level speaking, in commercial space for a unit of renovation code, generally there is more potential to realize a higher, both percentage and absolute equity gain. And then what you're saying is in hospitality commercial, that is further strengthened. So now it's not like, you can reach to 50% equity gain. You can actually raise the appraisal, like actually double and more than that in some scenarios. Is that your state, your experience?
I'll try to answer the question and see if I understood your question correctly, and just ask another way if I don't. But because it's a commercial property, so it's valued on the income it generates, right? It's an investment property. If it doesn't generate any income, it doesn't have any value essentially. So with these properties, just like commercial multifamily, it's valued on its net operating income. So if you double the net operating income, you've essentially doubled the value of the property. So your NOI is directly proportional to the value of the property. So if the NOI goes down, you're making less money, your value is going to come down. But if you can increase your NOI, you're going to increase your value. Did that answer your question?
Yeah. But in hospitality, you're able to increase your NOI by a higher factor. Is sort of.
Yeah. That's what more. Yeah. So because the properties we're buying were more mom and pop owner operated. They were I think all but one were like the primary residences as well. So like they weren't really business owners. They were more so just like collecting money to pay the bills and do whatever. Which is, for them, it was great. But for us, we just saw the opportunity to increase that NOI by doing the renovations, by doing the refurnishing, by changing the business plan and how we're attracting our guests. That's all driving like every one of those factors. Doing one of those alone would drive up the income, but we did all of them together, completely changed the business plan, and are doubling or tripling the value or the income and thus the value of the properties.
That's impressive. And that's it. What unit size or room size, I guess, for
so right now the current portfolio is anywhere from 8 to 18. So we have an 8, a 14, a 15, and a 18. Gotcha. Cool. So yeah, this, that's compared to, in multifamily where you might be able to, increase the NOI like 10%, which would be really, really good, right? Because that's going to increase your value by your, if your NOI goes up 10%, your value is going to go up. But when we're doubling the NOI, it's it's a little bit different factor. So where the differences begin. So we talked about the long-term, the commercial multifamily. Let's talk about, the differences of owning and operating short-term rentals. So starting out, first of all, you got to plan on your design and your furnishing budget. So typically if you're doing value add, multifamily or real estate or just, residential real estate, you've got renovation, you've got holding costs, but with short-term rentals, you've also got your furnishing costs, your design fee if you're using a designer. So what I see typically is like $3,000 to $5,000 per unit that sleeps, anywhere from 2 to 4 guests. If you're furnishing a full house, that number could easily triple. If you're doing a 3-bed, 2-bath house, you could easily be 12 to 15,000. But we've been able to source our furniture in bulk and buy local, and have use Facebook Marketplace. Facebook Marketplace can definitely be your friend. You can find some nice things on there, and furnish ours for a really low cost, so that we can get a bigger bang for our buck. And outsource where and if you can. Right at the beginning, my wife and I did everything. We'd go pick up every piece of furniture. We'd load it in my truck. We would drop it off. She would do the design. I'd do the heavy lifting and hold up the pictures for her so she could decide where they go. This is actually the guest unit. This picture is the guest unit of a main house that we bought and renovated and furnished in 2020. So this is one that we were kind of in that phase of doing everything ourselves. But as we've moved along, we've found a really great furnisher. She has awesome designs, like does all that, picks out the furniture, buys the furniture, sets it up, and we come in at the end. It's like, holy crap, there's everything. And that's a good feeling. And what you want to shoot for is a clean, functional design. You don't want any like old, outdated furniture. You don't want anything that's too messy or too busy. Current guests like the clean and functional design. And what you can do to really set yourself apart is have a unit that has some kind of theme, and the theme really goes based on, your location. So if you're in the mountains, you probably wouldn't want to do a beach theme. And here in Panama City Beach, we're not going to do like a tree house, like a mountain cabin or something like that. So we have very beachy properties, bright blues and greens and things like that. Pull into that coastal atmosphere that people travel to this location for. We've got units like the Sandpiper and Seahorse Reef, and I can't even think of the other names, but like the Dolphin Room. There's all these kind of like nautical themes that bring into the location that the guests kind of expect and want when they're going on vacation, by the beach. So listing basics. So what are you going to do to get your listing up and running? I always suggest what I mentioned in the beginning is start just with Airbnb, because what that's going to do is you're going to build up your reviews on one platform, and that's going to, increase your rankings. That's going to increase your bookings. That's going to increase your revenue. And it really allows you to hone your craft. It gets you familiar with the booking platform. Airbnb is just a booking platform. So it gets you familiar with that, used to their systems, to their support, their policies, dealing with guests that use the system. Like Airbnb spends, I don't know the exact figure, probably like $1 billion a year marketing and gaining guests. So they're marketing and drawing in specific avatars that expect certain things. So, you want to get a feel for the guests that you're catering to through that booking platform. And if you were to start on Airbnb and VRBO and Expedia, that's 3 different places where you're going to be getting reviews, and it's going to be scattered. So none of those different platforms are going to be able to build your reviews. So it's really going to hurt your search ranking, your optimization on each platform. So that's why I say start with Airbnb, build your reviews there, get 25 to 50 reviews on one platform before you sync out and start using VRBO and stuff like that, because that's going to optimize your income and your search ranking there. Also, you're really going to shoot yourself in the foot if you're not getting professional photos. So I don't care if you have an iPhone 13 Pro Max with the 3 cameras and you've got the best editing software in your iPhone in the world. Just hire a photographer anywhere from like $100 to $250, maybe a little bit more, but that's typically the range I pay depending on the size of the house. $100 to $250. They come in, take amazing professional photos, wide angle lenses. They do the editing, and it really makes you stand out. Like you can tell as you're scrolling on the app, looking for a place to stay, a place that has professional photos versus one that does not. And the one that does not is not going to catch your eye, and you're going to book the one that has professional photos most of the time, all things equal. Also, in your listing, you want to explain the pros and cons. And that might sound like counterintuitive. I know I want to explain the pros, but why would I explain the cons of my listing? And the reason you want to do that is because you don't want guests to show up to your listing, not expect something, or it's something a little bit different than what they might have expected, and then they give you a bad review for it. So your lifeblood as a short-term rental host is your reviews. So if you can call those things out beforehand in your listing or in your automated messages, hey, there's construction this week, whatever, or the last guest broke the lamp and we've got one on backorder. Just wanted to let you guys know. If you call out those pros, it's not going to be a surprise to them when they arrive, and it's going to be one of those things that you communicated with them. It's okay. Everything else is great. Boom, good review. That helps you out. Also, I'm going through these quick. So, I could spend a whole hour just talking about the listings, but you also want to have a clear and concise title. That's like your marketing for the listing. Like a really weak title sticks out as in the fact that it doesn't, because you just scroll past it, but it's noticeably bad when you see those. And a good title draws you in, makes you pause, you look at it, you look at the photos, and then you click on the listing, and you're more likely to read about it just because the title pulled you in. So if you can spend a little bit extra time, calling out your amenities, calling out what it is, makes your space special, people are going to be more likely to book it. And then finally, once you get into the actual listing description, use every section. So there's the space, or there's the overview, there's the space, the other things to note, neighborhood description, all those different things. Like use each one of those boxes and think of those as like your marketing, your property to your future potential guests. Like if you're not using one of those sections, you're giving up a potential advertisement that would attract a guest to book your place. So use every one of them, and make your listing stand out as a good listing. All right, short-term rental management systems. This is probably the most important one, because this is what is gonna, I guess, make or break how successful you're gonna be, right? Because short-term rentals, I'm not gonna lie, is more work, but by systematizing the workflows and using the right, the software stack, like I'm going to talk about, that's really going to cut down the time that you're pulled into it and the time you spend on your short-term rental business. So by using the right things, it can be, somewhat passive. It's still going to require some input from you, some decision-making, some dealing with guests at times. But if you can use this right tech stack, get that down to your involvement to a minimum, the increased cash flow and benefits are well worth it. Trust me on that one. So the first one is the channel management. So I listed, just 3 of them. There's probably 100 now. It's such a hot space. It's like the short-term rental industry is blowing up. There's a million different channel managers, but these are 3 of the ones that I have either used or have people that I know really well that are using and speak really highly of. I bolded all the systems that we use. So we used HostAway. It's got all of our calendars in one spot. It's got a unified inbox. We can manage our workflows from there. We can see all our financials. I spend a lot of time in HostAway, and I think it's a really good system. Smart BNB is really good if you're only using Airbnb, and if you've got less listings. We've got 63 now. So a bigger, more robust system is definitely a must for us. It's also got automated messaging, which cuts down a lot of involvement from you, which is, I can't even describe in words how important that is. Next is the pricing software. So guys, if you get into short-term rentals and you don't use pricing software, you're absolutely leaving money on the table, and you're likely going to have either too high occupancy at too low of rates, meaning you're missing out on a lot of revenue, or you're going to have way too much vacancy because your rates are too high. So what these do is that fluctuates your pricing based on demand, and get you booked at, basically optimizes your revenue through your pricing structure, taking in different factors into account, like demand, weekend pricing, events, seasonality, all those different things. So it's a must, I think. Also, smart locks, it automates check-in. Guests do not want to, see you or talk to a host before they check in. They want to come in at their leisure, get into their place, use the code, whatever it is, and get into their unit and enjoy their stay. So we use Schleg that sends, connects with our Hostaway, our property management system. Every time a guest books, it, takes from their listing details, takes their phone number and makes the door code the last 4 digits of their phone number, and it doesn't require any input from us. It only makes it eligible to use on the code during their check-in window, from their check-in time to their check-in, or the check-in to check-out time. So we don't have to manage that. Guests get in on time. It makes it more safe because other guests can't go back and barge in because they know the code, because it changes with every guest. So those are really like the 3 main systems that we do use. More than this, we have e-concierge service and guidebooks and different things like that to really take it to the next level. But starting out, you need a channel manager, you need pricing software, and you need a smart lock. Those are like the 3 must-haves. I think Hostaway to start out is like $19 a listing a month. Price Labs is like $9 a month, and the Schleg app is free, but the lock's like $230. So you're talking like a initial buy-in of like $250 a month, and that's like a weekend booking, for a short-term rental. So well worth it if you're going to manage yourself. And then at the bottom, I've got property management, which is going to be, they're going to do all this stuff for you. You buy the property, furnish it, hand it off to property management, but they're going to take 20 to 30% off the top line of your revenue. So, just things to weigh, pros and cons, do it yourself, make more, be more involved, or hand it over to property manager and be less involved, but make less money.
Right. So just a question we have on the chat actually as well. So when you go talk about Hostaway, let's say channel management. So what exactly is channel management? Is it just like sort of posting out to the different Airbnb, VRBO, etc., or does it do more than that? And you mentioned it's also your property management software as well, right? So how does that first part work?
So channel manager has kind of become a term that encompasses more, but as it started, channel management, property management system were like 2 different things. And now it's like all integrated. So all these things here do channel management. They do, they are the property management system and the channel manager. It's all in the features that the software offers you. So the channel manager is what allows you to put your listing on different booking platforms. Think Airbnb, VRBO, Expedia, what have you, all those different booking platforms. And then it syncs them back to that system. It keeps your calendars up to date. It, prevents double bookings. You have one calendar for your listing, and you can see, did they book from Airbnb, your VRBO, all that kind of thing. So that is like the base function of a channel manager, is it manages all the channels that you could list your listing on. Property management system does much more. It's the automated messaging, it's the financials, it's the tags that you put, to keep things organized and, pull things like the door codes into the automated messages. So there's a lot more in property management systems. And that's where you get a lot of difference in the features of all these different softwares, is there's a million different things out there that the softwares offer, but they all have channel management within it. It's like the base function is channel management. But property management is where it gets, more to your preference, more to your listing level and kind of what you're doing. Did that answer the question? Yeah. And so we have a couple more questions on this, but we can relate at the end. That's okay. Cool. Yeah. Throw them at me. Am I reading them? All right, let me pull them up. Do they automatically adjust pricing in your Airbnb listing? So yes, Nelson asked that question. So yes, the pricing software is something that, if you wanted to, excuse me, I'm sorry for the coughing. If you wanted to, you could, set your pricing. You have a minimum that you're willing to accept to take a booking. You have a base price, and then you have a maximum price, which you could either leave that open or you can, put a kind of arbitrary cap, because ultimately there's an end value that somebody would be willing to pay for any given space. So you set those pricings, and then you can, adjust different things like weekend prices. If you could go down the calendar and say for 4th of July, you could put a rule over that dates to say, I want 4th of July weekend to be 10% higher. But yes, you can set your pricing software and not have to worry about it. But what I would do is I would, at a minimum, do it 2 times a year. Do it at the start of your high season, readjust, rechange your base prices, and it's going to fluctuate with demand, and your further out bookings are going to be a little bit higher. And then set it at the beginning of your low season so that at no given time your pricing is going to be too off, and that'll help maximize your revenue. But what I do now with properties in different locations and in different markets, different listing types, there's so many different factors. I probably get into our pricing software a couple of times a week and check on things and really do more of revenue management to make sure the portfolio as a whole is performing well. But on a single property, set it, twice, beginning of high season, beginning of low season, and it does its thing all year.
Mhm.
Why did you decide to use Price Labs instead of AirDNA pricing? So for all those reasons I was just talking about, Price Labs, you set your pricing, but Price Labs helps adjust your prices to optimize your revenue. So it avoids you charging too low for high demand dates and too much for low demand dates. It levels that out. So I think Price Labs data, the last time they released it, is like you're going to make roughly 20% more by having pricing software that adjusts for, occupancy and adjusts for demand and seasonality, because you're going to be optimizing the prices that you're charging for any given day. And in AirDNA, as far as I know, you can just check market prices, and that's what you would use to go update your settings in something like Price Labs to say, hey, this is my minimum price, this is my baseline price based on my research that I've done in AirDNA. I don't know if AirDNA has pricing software. I don't think so, unless it's a new feature. I think they have dynamic pricing too. I did not know that, but
Can you hear me?
they do pull a lot of good data, so maybe it's a good one. But I know Price Labs, they pull, they have a huge data source. So I like Price Labs a lot.
Yeah, Nelson, you got a question?
Yes. Blake, can you hear me? I just have one.
Yes.
Okay, fantastic. So with Price Labs, when you're using that pricing data, does it break it down by zip code? Because you could have a property that's
It does. Yeah. You can do, Price Labs will do market reports, and you can select it by, city or by zip code, and it'll basically pull all the data for all the listings in all the active listings in that zip code or in that city.
okay. Because for example, let's say Fort Lauderdale, you could have a property that's in the quote unquote hood, same zip code, 3 blocks over, and your luxury.
Yeah. And I don't know how good it is on that specifically. Because I don't have any, properties that I've been able to split test, that's in the same zip code. That's, this one's a really good neighborhood and this one's a really bad neighborhood. So I don't know for certain on that. Yeah, but I know it does pull in like the zip code specifically, but I think that's where you, as the person that, setting the parameters for it, is important to do your market research and know the market, and not just rely on the software, because none of this stuff on this slide that you guys are seeing is perfect. Like, if you don't set up the smart lock correctly, like you could have codes that don't work and guests that could get in, right? And if you don't adjust your Price Lab settings correctly, you could be way undercharging or not having anybody book because your prices are too high, which is what a ton of property managers do. They just don't mess with their pricing. So in the low season, they just don't make any money, which is crazy to me. And then HostAway, SmartBNB, Cassidy, they all have their own problems. So it just takes some discernment, on your end for that one.
So with the price labs, let's say it's the rate and the high season is, I'm just gonna make up a number, $100 a night.
Mhm.
And then I know that the market rate is 100. If I know that the market rate is 100, why would I want to use price labs if I've done my own homework?
Yeah, because what you're going to miss out just by knowing that the market rate is $100 is the fluctuation in the short term space, right? It's just like airline flights, right? If you book on a Tuesday, it's going to be more than or be less than your flight on like a Friday or Sunday, or whatever that scenario is. And the same is true with short-term rental pricing. So your Monday through Thursday nights typically are going to be lower rates than your Friday, Saturday, Sundays. You have a lot of checkouts on Thursdays and a lot of check-ins on Fridays. Weekend pricing is always going to be higher. If you have a festival that's coming into town Monday through Wednesday, it's going to, see the demand and the increased bookings for that given time and adjust, your prices upward to match that demand. And that's something that, you might not be keeping tabs on and going into the local Chamber of Commerce website to look on all the events coming into your area or whatever it is, So Price Labs is going to catch a lot of what you can't,
Well, 1 second, Blake. So let's say, using that example, there's something going to happen on a weekend. I have it for $100 a day. There's a festival on that weekend. It will automatically bump it up to, let's say, 150 a night, 250.
I don't know how to answer that with certainty, but in theory, yes, that's how the software is supposed to work. Is if there's, something going on that's causing more people to book, like it's gathering all that data and then adjusting all the listings, or it's adjusting your prices based on what's happening with all the other listings in the market. So they're going to capture the demand changes and all that, and all the data on the back end to adjust your prices accordingly to give you a better, to optimize your revenue. So I don't want to dig too deep on this because I'm not like a Price Lab sponsor. It's just what I use. You can go to Price Labs. They have tons of videos that I've used to learn the system and to learn how to use it better. No, super great.
Yeah, this is not meant to put you on the spot for, you're not the Price Lab guy. But thank you very much.
Yeah, absolutely. It's been a big help. Like I've been a host that hasn't used pricing software, and I've used different ones, and finally fell on Price Labs. But I've not used it, and I've used it, and the difference is night and day. I used to go in and like manually, what you're saying, adjust all my own prices, look, be scrolling on the Facebook page to see what's happening in the next couple months to try to capture some of those dates. And it's just so management intensive. And if you want to do that, you can, but Price Labs just, its job is to make your life easier and make you more money without you spending so much time doing it. So it's been a huge asset.
Thanks, Blake. So
yep.
just
I'm gonna go. I know are we getting towards the end here? I can start wrapping up.
Yeah, we're actually a little over time. So do you have
okay.
Blake? Yeah.
Let me see. This is a pro tip. I'll send out these slides to you, Stefan, and then you can send them out to everybody if they want to get on the rest of them. But yeah, that's basically. I was just going to talk a little bit about more pro tips and how to optimize your revenue with short-term rentals. But appreciate the questions. If you guys got any more, Stefan, I'll hand it back to you and let you wrap this thing up.
Okay, yeah. Thanks, Blake. So, we have a couple of questions. Do you have like a couple of minutes only? Is that okay? If we can go like real quick, or is it a hard stop you have?
Yeah, I got a couple more minutes. I got about 5 more minutes if we want to hit.
Okay. So just so we have one question. So, what are some of your preferred online resources for finding multifamily or hospitality deals?
Some of my preferred resources or locations, like places to find multifamily.
Yeah, assume online, kind of technology resources, etc., like data vendors.
Yeah, I would say, I hear a lot of crap talked about LoopNet, but I found deals on LoopNet. And I think that's a place to look and kind of see what's out there, especially maybe if you're not seasoned and looking for your next deal. But if you're looking to kind of gauge a market and see what's out there and kind of just build your repertoire, I think LoopNet has some value. It's definitely the place that a lot of deals go to die. But if you know how to add value to real estate, if you know what to look for, if you know how to increase the NOI, which is going to increase your value, if you know how to do those things, or like, have a good intuition of how to make it happen, you can absolutely find deals. But yeah, I think the best way to find multifamily right now is building your network, meeting other sponsors, meeting brokers, getting in person, shaking hands, showing people that you're a real person, that you've done some deals, and that you can close deals. I think that is probably, the most tried and true method of just having the experience. And if you don't have any experience, find the people that do and partner with them.
So just from that, Blake, because it feels like really critical to like your thesis where like BrrrrBNB, right, is the best with sort of for equity gain plus cash flow, right? So that's kind of like your thesis.
Plus with the BRRRR strategy, you just you get repetitions, right? You go through the whole process. Like you do a whole deal stage, you do every, other than selling it, like you do every piece of it. So you get repetitions that serve you in the long run.
Let me ask you this, Blake. So because for the 8 to 18 unit properties where you want to realize an equity gain by NOI, do they have a different use case? Do they have a use case as regular residential kind of multifamily buildings of an 8-unit multifamily building where an appraiser can come in and say, okay, that's the use case. That's where we're going to underwrite it according to its long-term revenue, let's say. Or are they exclusively, okay, that's an inn or that's an obvious hotel of sort? That's like kind of like an important thing because I've looked into some of those deals.
Yeah, no, that's super important. That's a good question. So like for all the places that we've bought, they have been zoned either excuse me, either been zoned multifamily or zoned commercial with like a hotel motel use. So what they're doing, when they go to appraise it, that's what they use is like the building use, whether it be hotel motel or whatever. And one was multifamily that was converted. But yeah, the answer is yes. But by doing that, you're getting into an asset class that has less competition. And as long as your building use matches in your local zoning laws of what can be used as a short-term or transient rental, you'll be good there. And then, they're going to do the income-based approach to value you.
Hey,
thank you so much. Nelson, sorry, because Blake will have to go. Do you have a minute? You have a minute for that, Blake?
Yeah, sure. I got time for Nelson's question. What's up, Nelson?
I was going to ask you, so how do you work with investors? How are you working with investors?
It's been a long chain of different things. I mean, from the very beginning, it was, partnerships, eventually to, hard money. And then, through connections, getting to private money. We did a syndication where it was a 506B. So we were able to, do friends and family. So we used the, mutual connections to come in and invest in the deal with us. And then on the recent round of acquisitions was just, again, personal network that people that we knew that trusted in us and wanted to invest in us and our business.
Blake, thank you. Stefan, thank you very much. And Blake,
absolutely. Yeah. Thanks for the good questions. You were hammering me on the price labs. I got to find some better price labs responses for you.
One former military guy to another.
There you go. Always be prepared. That's right.
Mm-hmm.
All right, Stefan. Well, thanks for having me on here. It was great. Thank you guys for the questions and allowing me to come talk to you guys. And I got, I don't know if reach out. I was gonna say I put my my Instagram on there. If you guys shoot me a message, I'll get back to you. We'd be happy to answer any questions, hospitality wise or multifamily or anything like that you guys might have.
Perfect. Sounds good. Thank you so much. Thanks to everyone for joining us.
Thanks, guys.